On April 3, 2025, the U.S. government announced sweeping new tariffs on goods from 185 countries. These Liberation Day tariffs, as the White House calls them, represent the most protectionist trade policy in over a century. The tariffs, effective April 5 and 9, impose a baseline 10% rate on all imports. Bad actors on trade face even higher rates. This aggressive move aims to boost domestic manufacturing by curbing imports. The White House acknowledges the difficulty in precisely calculating existing trade barriers. Their solution: impose high tariffs to eliminate trade surpluses with the U.S. However, critics argue this approach ignores the complexity of global supply chains. They point out that the tariffs also impact products the U.S. doesn't produce domestically, potentially leading to price hikes for consumers. News of the tariffs sent shockwaves through Wall Street. Major indices plummeted, reflecting investor fear and uncertainty. The Dow Jones Industrial Average, a key indicator of U.S. market health, plunged over 1,500 points, a drop of more than 3.5%. This dramatic fall underscores the severity of the situation and the depth of investor concern. The broader S&P 500, representing 500 large companies, wasn't spared either. It tumbled over 4%, mirroring the Dow's trajectory. The tech-heavy NASDAQ composite, known for its volatility, experienced an even steeper decline, plummeting nearly 5%. These market reactions reveal widespread anxiety about the tariffs' potential impact on corporate profits and economic growth. The shockwaves from the U.S. tariffs quickly reverberated across international markets. Asian markets were among the first to react, with Japan's Nikkei 225 index dropping 2.77%. South Korea's Kospi index also fell, although less sharply, by 0.76%. These declines demonstrate the interconnectedness of global markets and the ripple effect of U.S. policy decisions. European markets followed suit, with the Pan-European Stocks 600 index falling 1.6%. Germany's DAX, France's CAC 40 and the UK's FTSE 100 all experienced significant declines. Notably, the technology and banking sectors were hit particularly hard, reflecting concerns about global supply chain disruptions and potential loan defaults. The tariffs have injected a significant degree of uncertainty into the global economic outlook. Analysts warn of a potential trade war, with retaliatory tariffs from other countries. Such a scenario could have severe consequences for global trade, economic growth, and geopolitical stability. Businesses and consumers alike face a period of heightened volatility and potential economic hardship. While the immediate market reaction has been undeniably negative, the long-term impact of these tariffs remains to be seen. Some economists argue that they could ultimately benefit the U.S. economy by boosting domestic manufacturing and creating jobs. However, others warn of the risks of inflation, reduced consumer spending, and retaliation from trading partners.